your views on volatility and the suppression of volatility that we've seen in the last few days. Do you think that continues, and how much of that is down to the kind of support that we're seeing from the central banks?
Hi, thank you. Good morning, and thanks for having me on the show. I mean, we are certainly seeing volatility having come down, but again, they have come down from a very excessive level. And so I think it's reflecting of the fact that you have had the rush in terms of capital outflows, record capital outflows out of EM in March. And the market have had to experience very weak liquidity at the same time, given that many countries are under lockdown, traders working from home, investors are not engaging in the market, and most importantly, we have no dollar flowing in a global trade sense. So that really an unprecedented shock to many of the currencies, and the liquidity in FX has been very poor, and volatility has surged to reflect that. Now we sort of enter a more recovery phase, I would say, but it's too soon to see that we are out of the woods. And I think that in the near term, we are likely to see volatility stay at current level rather than further decrease from here. With that, I think we remain fairly cautious on our view in terms of dollar against EM currencies, and we do expect some further dollar strength going forward.
Further dollar strength going forward, even as you say, things seem to be improving, at least around the edges. In terms of Korea, of course, we've got the Bank of Korea keeping rates on hold and some strength there for the Korean won. That's one of your favoured picks. Explain the rationale for continued strength for the Korean won.
I think Korean won is where I can build a case for relative outperformance. Clearly, we had the shock in March, which boosted dollar Korea to nearly as high as 1,300. But now we are seeing support coming from a number of factors. The most important, in my view, is the fact that BOK is starting to supply dollar from the Fed swap lines, and they still have substantial scope to increase, given total 60 billion supply coming from that, and only about less than a fifth has been used so far. The second is when it comes to, the fundamentals of Korea economy. Yes, we are going to see growth at the weakest, or even weaker than the global financial crisis, and fell well short of BOK earlier forecasts. However, in terms of how Korea has handled the COVID outbreak locally, it in fact has done a lot better than other countries in terms of maintaining or flattening the curve without significantly hurt economic activity. So I see some room for Korea economy to outperform on the recovery side as well. In terms of the tech sector performance, the demand for work from home, data center, DRAM and NAND is likely to support Korea export revenue going forward as well. So all that factors point to, Korea will still be sensitive to global equity sentiments and global factors, but the fundamentals are fairly supported coming from both the BOK and the economy, as well as the capacity for government to increase fiscal stimulus there.
Trang, but the won is seen as a proxy for trading FX risk in the region. So if we're expecting the won to stabilize, should we expect other Asian currencies to follow suit?
I think we need to really take it in the context, and we are facing an unprecedented shock, and it's not. I don't think we should use the previous what we tend to see, that the one is simply a risk proxy, as the new normal going forward. I do see that, given that the market has already punished or has already took Korean won a lot weaker in March, and economic recovery is going slightly better for Korea. There's a case for Korea outperformance building there. Remember that in terms of the dollar supply, which I said earlier is a major issue for EM countries, Korea and Singapore stand out because they're having the dollar swap supply from the Fed. So they are in a lot better position in this crisis compared to other currencies in the region.
Yeah, let's talk about those that are still maybe could see some punishing. You're talking about the rupiah and the rupiah as well. Why are we not out of the woods yet?
Yeah, I think the key here is, I would say that the worst part of the sell-off in terms of the rush for capital outflows are over, at least for Indonesia, given the extent of foreign fixed income selling that we saw in March, which was, the highest on record. However, it's still too early to say that, we start to enter into a recovery period. Part of the reason is the dollar liquidity remains weak. And the second is, BI, Bank Indonesia, have very low capacity to defend, given the relative size of its FX reserve to other metrics like short-term debt, or even the absolute size of FX reserve in Indonesia. I think the next 2 weeks will be a very important observation period when it comes to the rupiah. We need to see, both in terms of global statistics, new cases, as well as how the situation is going in Indonesia locally after more stringent measures are now announced in Jakarta. Importantly, we want to see sign of normalization in local FX liquidity. And so far, we remain skeptical that liquidity remains too poor, and we need to brace ourselves for more volatility there.
Trung, with the yuan, the Chinese currency, currently trading at around 7.06, you've got a forecast second quarter where it gets to 7.35, and then it strengthens again. Walk us through the steps. What are the factors that are playing in to the Chinese currency at this point, and your targets for the year end?
Yeah. So when we look at the RMB, I think a lot of people have talked about, RMB outperformance, or even RMB as a safe haven for the current ex-China outbreak. And we did indeed see CNY strengthen on a basket basis in March. However, for now, half of that gains has retraced, and I do expect RMB outperformance to lessen going forward. The reason is China is simply not China as an economy is simply, not insulated from global shock. If anything, global shock and weakening in global external demand is likely to have a second round hit on China demand, even though, domestically we are seeing production resumption right now. So we need to watch out for a second dip when it comes to China growth. When it comes to the RMB, I think there are two factors here. The first is that we still have very, very high part of external debt or dollar borrowing from China corporates, especially the more vulnerable sectors like property sectors. Those guys will need to fight dollar to either roll over or hedge their existing positions. And this short-term external liability stood at about 1.5 trillion if you include also offshore debt borrowing. That is a half of China FX reserves. And the second is that, I don't think there is a very strong policy incentive within China now to keep FX at a level. If anything, I think policymakers in China has increasingly understand the importance of having a very flexible FX regime. And any policy focus at the moment likely to need to be on interest rate cuts and liquidity easing locally. So near-term stress, but once we get over this period and we see global recovery, we see RMB back below 7 again.